Hayes got a number of moving pieces at the White House here today. The most notable being that we are expecting executives from 4 top retail companies. That's Walmart, Target, Home Depot, and Lowe's, all here this afternoon for a meeting with the president. Now, White House officials have confirmed the meeting this afternoon, but they would not say exactly what officials will be discussing. We can, of course, expect that tariffs are on the agenda. All 4 companies dependent to varying degrees on imports from abroad. Now, the meeting does come as the president has said that he would be willing to talk with companies about these tariffs, and it comes just after he posted on social media over the weekend that businessmen who criticize his tariffs are not only bad at business, he says, they're also bad at politics. 2 other topics this afternoon, Scott. On trade generally, I am told that negotiations are still ongoing, of course, with a number of nations, and that a couple of those, maybe 1 or 2, are close to being done but not finalized just yet. The White House does believe, though, that those first announcements, once they come, could bring sort of a domino effect that they believe will boost the markets, but a lot of wait and see as we wait to see how much more we get potentially this week, maybe next. And finally, the president once again going after Fed Chair Jerome Powell earlier today, pressuring him to lower rates, calling him both Mr. Too Late and a, quote, major loser. And Scott, I've been told by an official here not to read this post as an escalation, but rather a continuation of the president airing his grievances as he did last week. This official told me the president is studying the idea of firing Powell, not going further than that at this point. Scott?
All right, Megan, thank you for that. Megan Casella at the White House. While the president's persistent pounding on Chair Powell continues to weigh on sentiment, our senior economics correspondent, Steve Leisman, is here with more. So it's good to see you. You heard Megan's reporting. They're studying the idea of potentially firing Powell. It's the sentiment alone, not necessarily, I think, Steve, that people think that they'll go through with it, but the mere talk of it is definitely impacting sentiment, it seems.
Well, it seems as if, Scott, that you have to, as an investor in this market, put some probability on the possibility that the president will replace Chair Powell before his term is up. I don't know what that probability is. We had Larry Lindsey on who says it's not going to happen at all. At the same time, you look at the trade and you look at the commentary of somebody like Krishna Guha from Evercore ISI, and he says this market is what happens when you toy with the idea. So Kevin Hassett, not quite sure what to do with that remark of his. He may have just been saying it because he had to say it. That's Larry Lindsey's take on it, that he can't say we're not studying it because the president seems to be interested in it. But, Scott, I guess I would offer the following. The president has shown that there is no conventional wisdom or conventional legal interpretation that he is unwilling to rethink. So he will do rethink all of those things in a new and different and novel way that we perhaps haven't thought of them before. If it comes to the Supreme Court, when it comes to firing federal government employees, when it comes to tariffs. So why not also with the Federal Reserve? I don't know what the probability is of that. I just think you cannot trade in this market without putting some percentage chance on it.
I'm just wondering what you also think about this idea of the so-called Sell America trade, where people look at what's going on. They're unnerved by the trade war. They're unnerved by what they hear from the president regarding the Fed chair and how direct it is and how escalated it's all become. And they're selling stocks, they're selling bonds, they're selling dollars. And how you think that's playing within the halls of the Fed? Well,
I think that it shouldn't be taken that far, Scott. I think if you're a money manager anywhere in the world, you still need to be putting money into the United States. It's still going to be a #1 destination. That said, we know that global trade patterns are being disrupted and will be disrupted by the tariff situation. So what does that mean? It means that some amount of money is not going to China and is not going to come back into our bond market. There's some possibility China will be reducing its flows or reducing its holdings of those bonds or U.S. dollar assets, as well as other countries that did a robust trade with this country. And that comes at a time when it does not appear on the other side that the budget from the Trump administration or the one being discussed in Congress right now will reduce the deficit. So there is no change in the need for us to finance our deficit. At the same time, we're foreclosing an option that was available to us from overseas. How much is that? Nobody really knows. I think what's happening now, Scott, is not necessarily the selling wholesale of U.S. assets, but it's a reduction in the status of U.S. assets from the primacy that they've held, but not really coming off the top the way it has been in the past.
I appreciate your insight on that, Steve. Thank you. Steve Leisman, our senior economics correspondent. All of this adding up to a perfect storm of pessimism lately about U.S. stocks. For more on that, let's bring in Adam Parker. He is the founder and CEO of Trivariate Research and a CNBC contributor. It's good to see you. I mean, you've been making the point that you've been feeling sort of worse and worse about the position of U.S. stocks. You'd like that to change, but it just hasn't.
Yeah, I think, look, there's nothing better than if you can be a contrarian bull and then be right. And you and I have talked about that in the past, but it's really hard when there's this much uncertainty, when the earnings estimates are way too high. They're always too high, but they're way too high. And we haven't seen any of that behavior yet where stocks that are missing aren't going down. You asked Leisman a question I can actually give a factual answer to. Where, the poly market has 20 cents, so 20% chance that Trump gets rid of Powell this year. So for whatever that's worth, I think that's what you got to factor into your distribution of outcomes. You can buy it for 21 or sell it for 81 cents right now. And you and I were together election night when we learned the poly market was right a lot.
But do you think, I mean, how much do you think the escalating tension on that issue is weighing on stocks in concert with all the other things that we're worried about?
I do. I think that's part of today's reasoning. I think it's got to be part of today's factor. It's just more uncertainty, and we know that they don't have a great relationship. And part of what I struggle with, and I think we talked about this last week, is if there's a recovery on the other side of this, it's got to include, the tax extension, less regulation, maybe some AI-proof cases, et cetera. But, there's also a belief that investors here in the U.S. have been programmed to believe that recoveries are V-shaped. And I think the reason they've been programmed to believe that is because you've always had monetary and fiscal stimulus simultaneously in most of their investment lifetimes. And what if this time the Fed isn't expanding the balance sheet and they aren't cutting a ton and there isn't incremental fiscal stimulus? Then maybe the upside isn't V-shaped, but it's kind of more of a slow grind higher. And that's what we're incorporating in our earnings outlook now, is that what I thought was 2026 earnings before, I now think it's 2027 earnings. I think we've lost a whole year of earnings growth because the policies have already happened.
The further we go out on the, I guess I would call it the negativity curve, does it lessen the chances for a quick snap on a perceived positive social media post?
I would have said that, but 12 days ago you got, 10% S&P in 1 hour. And, if you and I went to school, they would tell us there's 10% returns in a year. So there's certainly buying power. If we start believing that we're going to resolve this spat with China in a kind way, the market will rip higher in a very short term on that news. And I think that's what people like me and investors I talk to struggle with the most. What historical period do I use to evaluate and then assume that's the current regime? I don't have one. There really wasn't a tariff war. And that's why when I look back at what happens when the dollar weakened, the playbook's been totally different, or what do I do? So I find that even though I want to be defensively positioned, I know I have to own some offense, because if we get some, tweet or whatever, the market can be up 10% in 1 hour. So I have to figure out, is it bombed out alternative asset managers where I take a shot? Is it, semiconductors where, a lot of them are down 30 to 50% from highs, and that's about an average semiconductor correction. And maybe the fundamentals are bad, maybe China's a problem, maybe inventory is high, but I know it grows above GDP long term, and I know they're going to rip higher when he makes a positive tweet. So people are struggling with how to barbell it. That's what everyone always calls it. How to find some offense and defense in this sort of current regime.
It's just a strange period, I guess, because it feels like to some degree there's a almost willingness by the administration to let the market get worse and let the economy get worse. But on the other hand, you're like, well, but I've got to believe that Trump put still exists at some point, and they do care about the stock market and the economy, ... Don't they?
Yeah. I mean, I think we learned that the Trump put was at a different level than we thought the consensus thought at the election. But look, one thing I'm really confident in is the price of forward earnings you pay for stocks is really correlated to the margins. And the thing that appears to be the case is tariffs are bad for the margins for a lot of companies. And so if the average company's margins go lower, the average company's multiple is going to go lower, and that's the bear case. To me, if you want to be contrarian, here's the consensus trades. One, U.S. stock market is not as good as non-U.S. I've seen 1,000 reports on the end of U.S. exceptionalism. Two, the dollar weakens. Everybody believes that, right? Three, that that the Fed will ultimately be accommodative, right? And so if you want to be contrarian, what you say is, I like U.S. equities more than non-U.S. at some point, and I don't think the dollar's going to weaken. I'm consensus right now because I think in the really short-term window, it's hard to see what breaks this. But medium to long-term, I still like U.S. equities more than non-U.S. equities because I think the main growth themes that drive GDP globally, the U.S. stocks over-index toward, whether that's AI semis or AI software or life sciences or electrification industrials or all those big broad themes with stocks we love, the U.S. just has better companies. So I think the U.S. will ultimately land at trading at a premium and ultimately outperform. But, you could be in a 3-month to 6-month period here where that's not the case.
But, some are trying to get ahead of it now. For example, UBS today upgrades U.S. equities to attractive from neutral. While downside risks do remain, we believe the risk of a more severe economic downturn is now more limited. We see U.S. equities as attractive and note that periods of stress have historically offered long-term rewards for diversified investors who look through near-term volatility. In other words, see the forest through the trees. If you're a long-term investor, why not now? That seems to be the summation of what they and some others are at least trying to suggest.
Yeah, I don't think that that's the consensus view, personally.
It's definitely not. Yeah. That's part of the point, right?
Yeah,
the consensus view is easy to be negative. It's definitely not.
Maybe that's a good call. Yeah, I agree. That might be a good call. I tend to believe that's correct in a 6-month to 5-year view. I'm a little more tormented in the next 6 months just because I could see the case where, we still have some things we got to deal with, the budget deficit, the dollar, the tariffs, China, et cetera. And I think if you're a CEO of a big company, damage has already been done. I think the only thing that we're trying to figure out is how big is the lagged effect between the damage that's done and when it hits earnings. I was surprised, I think we talked about it last week down at the stock exchange, that the bank earnings were better than I thought. I didn't think we really saw anything, 90-day delinquencies are getting worse, or we've seen a slowdown. They kind of said things were okay, and that made me think either there's a bigger lag effect than we thought, or maybe Q2 earnings aren't the trough. Maybe it's Q3. And if Q3 earnings end up being the trough, the market's got a big leg lower still, and I don't want to get too aggressive yet.